Hi, my name is Susan Geffen. I'm a gerontologist and an elder law attorney. The topic of this video is how to pay for in-home care. There are several ways to pay for in-home care. Let's talk about one way that many people pay for in-home care. Many people use a pre-existing long-term care insurance policy that they purchased many years ago. These policies are great. These policies typically have a 90-day waiting period before they can be used. Those are called an elimination period. Long-term care insurance policies either pay for a daily rate or they have a maximum amount of money that they will make available to you over a period of time. That's called a cap. If you don't have a long-term care insurance policy, please look into getting one of those policies. This is a great way to offset the cost of care. Both my husband and I got a long-term care insurance policy when we were 47 years of age, and then we upped our limits several years later. Of course, a long-term care insurance policy is not for everybody. It's best to look into a long-term care insurance policy when you're younger, maybe maximum 65 years of age. If you can't afford a long-term care insurance policy, there are other types of insurance policies that allow you to tack on a long-term care addendum to them. I highly recommend that you look into this because, of course, as you probably know, the cost of care can be quite expensive. Another way to finance your in-home care is by getting a HECM, a home equity conversion mortgage. Most people know these by the name of a reverse mortgage. A reverse mortgage is a way to get equity out of your home in order to have money to pay for many things, but for most people, and for purposes of this video, how to pay for in-home care. A home equity conversion mortgage is a federally insured program, and it enables people to take money out of their home and not pay back principal or interest as long as they're alive and as long as they're living in their home. I had a client who was discharged from a nursing home, but before he was discharged, he and his family were told that he either had to go to an assisted living facility where he could get 24-hour care, or he had to go home with 24-hour caregivers. Well, he certainly did not want to go to an assisted living facility. This is a man who really enjoyed his Fraser's father's chair, which is what I called it, and his clicker. And there was nothing from his perspective that was going to keep him from leaving his home, except that he was living on a fixed income of $2,000 a month. How was he going to be able to afford a 24-hour caregiver? Well, I recommended that he get a reverse mortgage. This reverse mortgage that he got enabled him to stay in his home for 6 years until at which point he passed away. But by using the reverse mortgage, he was able to live life on his own terms, and he had a 24-hour caregiver with the money that he got out of his home. If you're a veteran, there's a benefit that's available to you as well. It's called the Aid and Attendance Benefit, and that's a program made available by the Veterans Administration. If you're a veteran and you served in one of the recognized periods of war for more than 90 days, and one of those days was a day of war, then you're eligible for that benefit. Like with Medi-Cal, you do have to satisfy some income and asset requirements, but many people can satisfy those. For a veteran, him or herself, you can get up to over $2,000 a month in benefits to pay for your caregiver. If you're the widowed spouse of a veteran, you can get over $1,100 a month. So that is definitely something to check into if you're a veteran or you're the widow of a veteran. While it's true that Medi-Cal typically pays for long-term care in a nursing home, there are some programs that are called community-based programs that can help you offset the cost of your in-home caregiving. One of those programs is called in-home supportive services. I would highly recommend that if you have a limited amount of income, that you call a Medi-Cal service representative to see if you can qualify for that benefit. I meet a lot of people who start withdrawing money from their IRAs in order to pay for caregivers. But this has massive tax consequences to some people. Instead of doing that, please ask your financial advisor about a new product called an IRA conversion annuity, which allows you to change the form of your IRA into a long-term care annuity and take out as much money as you need to take out without the type of tax consequences that might hurt you in the end. I've met a lot of people who think that they don't need to continue to pay for their life insurance premiums because their children are grown. And certainly, that is a motivating factor for most people to have life insurance. But I would ask you to think twice before you make that ultimate decision, because there's now a product available that allows you to receive a lump sum settlement for your death benefit. And that money goes into a long-term care irrevocable trust account from which the caregivers or the caregiving agency is paid directly. Upon your death, if there's money left over in that irrevocable care account, it goes to your beneficiaries just as if it had passed through your trust. I urge you to talk to your financial advisor about this product as well. It's very similar to the viatical settlements that became very popular during the AIDS epidemic, where people were selling their policies so that they could cash out some money in order to pay for their drugs. This policy in this type of product is now available to you as a consumer if you need to get money for your long-term care needs.